Good evening. My name is Daniel Young. I am the owner and founder of Adaptive Perspective and the Adaptive Perspective social media platforms. This video continues my advocacy for using closed-end funds in our investment strategy. If you want the full methodology and our 12 steps to financial freedom, then head over to Facebook and check out my page there called Adaptive Perspective, Navigate Your Finances, where I give the entire framework, everything for free. So normally I film these inside my house, but today I am outside my house because we're having an impromptu sleepover and the house is a little more noisy than I would like. So I'm here. This is an unedited video, so who knows what you'll hear in the background in my backyard. I am not a financial advisor. I am a financial strategist, and I don't speak like the herd. I walk in limited company, and sometimes I walk alone. So quite honestly, week to week, month to month, the strategy remains in place. Not much has changed in the financial world. Now, there's been a lot of goings on. We're starting to see more, we'll see more glimmers to the overall state of the economy. But the bigger picture of what most people see, not much has changed, except that more people are waking up to the realities that the Fed is lying about the economy. The Fed is printing more money again instead of doing it kind of off the charts of quantitative easing, where they're printing money. They're doing it a little more loudly. The inflation rate is off. You and I know this. I think the Fed printing money is causing those small boosts we're seeing in core inflation data, but you and I know that it's really off because everything at the grocery store is still really off. And most people think we're in a recession or we're just damn close to being in the recession. So where does that leave us? What's the best advice? Junk bonds are still junk bond investment vehicles for us. True consumer goods like ketchup, mustard, and Oreos are way too chaotic. And a lot of that's housed in a global scale, and that's just really way chaotic. The best thing we can do is to buy the best deals right now with a longer, grandiose game plan in mind. And I think we listen to two people. I mean, you can listen to me, but I'm going to reference two specific people. So I think we listen to Robert Kiyosaki. We take his advice that we buy what the Fed cannot print. So if you've watched my videos, what have we been targeting? Bonds, tech, utilities, if you can get them cheap, oil, energy infrastructure, all of that, and real estate. Because, I mean, everybody's talking real estate, but all of those things are things the Fed cannot print. So, I mean, to rehash, what can't the Fed print? Oil, tech, which is an oil derivative, and you can combine utilities into oil and tech. You can hit energy infrastructure with oil and tech. You look at real estate and bonds. None of those things the Fed can print, which means they can't devalue it. They can impact the pricing for them, but they cannot outright devalue those resources or those things. So in addition to Kiyosaki, I think we listen to Brett Owens. And when the Contrarian Outlook team, which is my favorite and only paid for advice service, repeatedly speaks the same message and other people start saying the same things, there's got to be blood in the water. Like I'm not a huge like the talk show circle junkie of financial advice, of advice, C-SPAN, CNN, the Motley Fool, all those guys that make the same circuit and say the same damn things. Those are not my go-to people. I look at Brett Owens, I look at Kiyosaki, I read everything I possibly can and make my own decisions. But when the talk show circle idiots and the Motley Fools of the world start saying the same thing the rest of us have been saying, it just says that a foolish olfactory deprived pig can finally find the truffle tube. And everybody has been saying bonds. like buy bonds instead of outright stock portfolios, instead of tech, instead of this, instead of that, buy bonds. But why? Well, that goes back to the Fed has more than hinted that they're going to go back into obvious printing mode as opposed to quiet printing mode, and the Fed will juice rates. So inflation's up. Inflation's been steady, honestly, from my opinion. I don't like it, but inflation's been steady at about 3% if you believe the Fed's numbers. And I don't believe the Fed's numbers. I think it's way higher than that. And that's why I say you and I know it's higher, because all the stuff at the grocery store is higher than a 3 to 4% core inflation, right? That's crap. But we're seeing these smaller spikes in inflation because the Fed's printing money. If everything stays the same and inflation stays the same, maybe you could tweak the system, right? But it's everything staying the same. The Fed's printing money. We're seeing these small boosts. And the Fed's like, hey, we're still in a great position. That tells me the Fed printing money is going back into raising our overall inflation rate. And even if you think the Fed says, hey, inflation's down by 2%, I still think it's still off. I think our inflation sits between 3 and 4% on a good year. And that's all Fed tweaking, right? So you and I know that the rate is a lot higher than it is. The inflation rate's a lot higher than it is. And you have the Fed more than quietly printing money and also acting like they're going to start cutting rates. And as Brett Owen said, and I'm not going to quote it directly, I'll get it wrong, but just like Brett Owen said, if you thought the Fed was going to raise rates in an election year, you're off your rocker. The Fed wants to sell the job on how well they're helping the country recover from the crazy inflation they created. The Fed printed a shitload of money in a really short amount of time and caused inflation. My 9-year-old daughter predicted inflation better than the Federal Reserve, which tells you the Federal Reserve is lying out the ass to the rest of us. And if they're lying in the good times, they're lying like hell in the bad times. So why are people picking bonds, right? You got to think of what happens when the market rate cuts. So if the Fed cuts rates, regardless of how you think of inflation, regardless of how you think the Fed will handle inflation, it's an election year. The Fed wants to sell the country and keep their job, that they're doing a good job, right? So they can cut rates. So what areas of the market will do best with a rate cut? All of them. Okay. Which are poised to improve the most? Well, when rates go down, bond prices go up. They are inversely tied, however you want to say that. When one goes down, the other goes up. If one goes up, the other goes down, right? So if you can snag a steal on bonds or loans or real estate right now, you'll rake when rates drop. And the Fed can't print bonds, but it can influence bonds, right? So where do we look? Well, in the overall market space of where we've been looking for deals, oil or energy infrastructure is surging. So even if you get the discount, you're paying a higher price. So unless we find oil, energy infrastructure, energy transfer, liquid natural gas, however you want to wrap that, or utilities, however you want to bundle that, unless we find it inside another portfolio, we're not going to be directly targeting oil. Bonds and loans are the main focus for right now. Tech is still bubbling. So one of the companies we own is 5G focused. So NBXG is cheap, but that price is also on the rise. Real estate's the outright dog. Like no one is mentioning real estate. There's still mixed review on overall office space. There's mixed review on a lot of the real estate market. No one really knows the long-term effects on the single-family home market yet. But real estate's the outright dog. But it's a loan, right? It's not a bond, but it's closely related. Falls in that same kind of deal of if the Fed lowers rates, that's a good thing, right? So if the Fed lowers rates, you get lower home rates and more people buying homes. That's good for the economy. You also get lower credit card interest rates or lower automobile interest rates, and all of that's good for the economy. So just because nobody's mentioning it doesn't mean we can outright avoid it. We ought to look at real estate. So if you can find a steal on real estate, in my eyes, that's a good thing. So let's check out the closed-end fund list for the week and we'll see where the bargains are. So let's see if I can quickly review this. So color codes. Gray doesn't fit our parameters. Purple is advised by somebody I read and trust. Dark blue is we own inside of our Roth account. Green we track for any number of reasons. Light blue we own inside our brokerage account, or our self-managed, however you want to say that, brokerage account. Triple asterisks are buy alerts, meaning that the current discount is double the historical discount and greater than the 5-year discount for that one specific fund. It's significantly different for the fund, but it's not significantly different compared to all the other funds. It's data that's significantly different for this one fund. 2 asterisks is a dollar cost average alert based on what we already own. And 1 we track for any number of reasons. So I update the blues, the purple, and the green every week, every weekend. I update the entire list every month. So, and I only did the blue, green, and purple this weekend. So if we rank by discount, and then we rank by target, we come up with a specialized list or a specific list of targets. We come over to our new spreadsheet. Current just means we already own it. So all of these are significant compared to that initial list. So we've already scaled by discount. So now we're going to scale or rank by a couple other things. Our goal is consistent monthly income. So business development companies, preferred in real estate. KYN is a great energy transfer utility company, but look, life flight flying overhead. Yeah, that's a fast helicopter in the background. It's a great company, but in the surge, it's a lot higher than it used to be. Plus, it's on that quarterly scale. So we want monthly income. So now that we're all here, now we can go by yield. I like a reverse. So our goal has been 9% and above, and I make 2 exceptions to the rule. We can get rid of these. HFRO remains the largest discount. So at a 50% off rate, for every dollar you spend, it's really like buying it for 50 cents. And it's really hard to ignore the rate. The HFRO portfolio fears are mixed. Let's say it's Jim Dondero is, I mean, yeah, he helms HFRO. He also is on the, I'm going to say he's on the Next Point real estate board. And HFRO is heavily invested in Next Point or whatever that other position he has. A lot of people didn't like the portfolio restructure from bonds to real estate. A lot of people don't like the kind of like self-invested form of HFRO into that other real estate front. But based on all the data, everybody's fears seem to be overblown, or maybe whatever that lingo is, oversold. HFRO is making money. They're clearing profit. They're paying dividends. And if rates cut, they are well positioned to gain back this dividend and increase it again. The other exception is this one. It's a municipal bond, so it's tax-free money. For our tax bracket, it's got a greater than 9% tax equivalent dividend. It's just as I select funds for our Roth, if you jump through the hoops and play the game on the Roth, yeah, yes, it's limited in the fact that you can only invest so much money a year, but it's tax-free money. Like it's completely tax-free. Uh, Capital gains, dividends, special dividends, all of that stuff, if you jump through the hoops, is tax-free. So getting a tax-free account into an account that's already tax-free doesn't make a ton of sense. So yes, it's greater than 9% tax equivalent. It would be great for the individual brokerage, perhaps long term, but past this cut, it's not going to make the list. So now we have a scaling list. So outside of HFRO, which cut their dividend in half, number lock used to be this, cut their dividend. I wish it were that. 0.077 used to be their dividend. I think it can scale back to that. But it's not that. Currently, it's that. So HFRO stays on the list because of what it was, of how it's structured, but really because it's the biggest discount. The other things that won't make the list. And I looked at all of this earlier. So I like the Calamos name. They've been on my radar for a really long time. What I dislike about the portfolios is the overall global makeup of things. And I get it. BRW is a global fund just based on how the description is structured, right? But I'm not a huge uh, global consumer guy, and both of their portfolios are portfolios in a can. Like you get a lot of access through all of them. They're diversified for you, but they're also heavy in that consumer market. And for a global fund, that really just seems to fluctuate a lot. But given the current nature of the market and kind of the focus of things, if we're looking at bonds, loans, real estate, let's see, bonds, loans, real estate, tech, if we can get it cheap, energy infrastructure, if we can get it through another fund, that doesn't fit the need right now. The other is Sabbath. It's mixed. When I go into Morningstar, it's a 50% government bond portfolio. When I look on their website, it's not outlined the same way. But of what I can see, just me, of what I can see between the Saba portfolio and the BRW portfolio, I like the BRW portfolio better, but that's just me. And there are people that love government bonds and how reliable they are. Uh, Senior loans, I think, seem to be, from what people say, they seem to be a little bit more risky. Maybe corporate bonds seem to be a little more risky, but they also seem to have a better payout. Let's see. TEEF is an interesting portfolio. It's it's based on a principle that it's based on two principles that I completely disagree with. If you're into alternative energy, it sounds like a great deal, but in order to get all of these alternative energies, you have to have oil. Like if you eliminated oil, got a really cool exhaust in the background. If you eliminated oil, then all of these alternative forms of energy go away. So to set up a portfolio that's based on all these alternative forms of energy and the elimination of oil, when all of your alternative energies require oil in order to work, doesn't make sense. Like wind, yeah, I get it, but that giant windmill is made through using oil. It takes oil to turn the blades. It also takes diesel fuel to turn the blades to a minimum RPM that would allow the wind in order to power that windmill. Solar panels are made with oil, right? Water turbine, oil, still oil in order to make. Like, you can't have it without oil. So to build a portfolio around the fact that you want everybody to go oil free would also eliminate your portfolio. It just doesn't make sense to me. But it's set up to, the fund itself is set up to, I guess, terminate or defund, however you want to say that, liquidate at 2031 at whatever the existing NAV price is. So you could buy it now for 20% off discount. And whatever the NAV is at sell, that's what you would get on a sell price. But that's a long way off. 7 years just to see what happened, or 6 years, 7 years to see what happens between now and then. And yeah, I'd rather actively invest elsewhere. ETW sounds interesting. It's another global fund. It's a portfolio in a can. It's advertised as heavy tech, and they use covered calls to juice the payout, which is very similar to what NBXG does. But at the same time, when you break out the portfolio in a can, it's not crazy tech. It's into a couple other things, but it's also just a global fund with a bigger portfolio, or a bigger consumer portfolio, and that's just not my style. So all of these are interesting, but they're just not me. And they also don't exactly meet the focus. This is stocks only, that's bonds too, but it's hard to on my end of things. There are people that buy into this, right? Like complete renewable, eliminate oil. The problem is oil is more utilized than you realize. Like, if you eliminate oil, you're getting rid of crutches and tennis shoes and pacemakers and refrigerators and laptops and cell phones, grills. Like, you're getting rid of a lot of other stuff that you just don't realize. So to go no oil and build a portfolio based on oil and government equity, meaning the government is subsidizing your profits through taxpayer expense, that just doesn't work well with me. So if we eliminate that, then we're left with what we already own. And of what we already own, these are the current numbers. So we own NBXG in both the individual brokerage and the Roth. We own 50 shares in each sector, or I guess in each account. What would we buy? So equals that amount minus the sum of those parts will give us a remainder. So I played with this earlier, and I know, I mean, the overall vantage point of technology is it's in a bubble, and who knows how much higher it's going to go. But I mean, there's where we bought NBXG in the individual account. If we look in the Roth, that's we're going to be buying in the Roth. Look at our initial buy-in price. Yes, it's higher right now, but NBXG is well structured, where I think it'll still continue to grow higher. Yes, it would cut into our profits, but I mean, it's not dollar cost averaging, but such is just the reality of buying stocks. All of these are in fact higher than where we bought them. The only exception is HFRO, and not by much. So of what we would buy, so you get bonds and loans in the US and abroad. You get a portfolio in a can. which has more consumer than I would like, which doesn't make this list. But I mean, gosh, real estate, energy infrastructure, so energy overall, right, with utilities, plus 15% of their portfolio is just bonds. That's well prepped for this market and the long run. Corporate bonds in the US only. I love that it's US only. Uh, Regardless of the choppiness of our economy, it's not like the choppiness of the global market. So I like a US only based company with overall technology. And then HFRO is, they really have restructured the portfolio. Um, it's mostly real estate or real estate based stuff. It used to be mostly bonds, but it really is mostly real estate. Um, if we completely bought everything, like if we used as much of what we have, we would buy a 50 stake in everything. Um, the annual dividend, yeah, would increase what we have by about 220. Uh, Monthly, yeah, would increase it by about $18. Um, what I what I generally like to do, so say we, because I like example, I like uh I don't know, I play devil's advocate with myself. Allergies are still killing me. So if we didn't invest in bonds, if we went with portfolio in a can, if we went with real estate and technology, what if we did this? You end up with 191.7 on a annual basis. Where are we? 191.7. And then I'm going to flip backwards. 191.7 compared to 220. Very different, yes, but I it's not the diversity for diversity's sake. It's and I don't and it's not so much spreading our resources over too much bread. Um, but I like investing into what we have. I I don't want to add more, meaning like I don't want to add stocks that we don't have unless we can really make a good investment into them. Um, I would like to add more to NBXG before it climbs higher. I would like to even those out to 200. Hmm, something rustling behind me. And then since we can, I mean, I would like to further invest into the bond market, whether the Fed cuts rates in the short term or whether they do it in the long term. And I said for a while, I hope they did it before summer, because that helps the general economy, that helps the public opinion, that helps people moving over the summer. Real estate is housed as a consumer market because it's cyclical, really based on the school year. But pending your market, like the Houston market, is always in motion versus we bought a investment property like a single family home in East Texas, and the market there is much more school year based. So it's much more cyclical. Um, I had a point with that, but I also completely lost it. But the hmm, consumer real estate, maybe a diversion. Either way, uh, but I like the idea of investing into real estate before cuts. There we go. The Fed rates. Um, I had hoped the Fed would cut rates for summer because that would really improve overall market opinion, but that didn't happen. So the latest conjecture that I see that makes the most sense would be the Fed will cut rates right before the presidential election cycle really kicks off. So maybe in September, which is right at the end of summer, which doesn't merge well into that general cyclical nature for real estate. But when you've got everybody back from summer, everybody back at work, their kids are in school, everybody's more focused around what's going on in the nation overall. More people will be aware of the upcoming presidential debates, all that stuff. When people are paying attention, the Fed will have everybody paying attention to them saying, hey, we're going to cut rates. And that improves overall opinion. That improves everybody's vision of the Fed. The Fed can say, hey, look, what a great job we did. It just doesn't help anybody moving over the summer. I mean, it's helpful, but it wouldn't be as helpful as if they cut rates a month ago. So whether the Fed is going to cut rates or whether they're not going to cut rates, I like the play into the bond market, whether it's higher for longer or whether they do cut it. I think it's a good play either way. So that's what I got for the week. Really, it's a reinvestment into everything we have in the Roth portfolio outside of OXLC because that's still at a crazy premium. And just of note, this fund, they do sell covered calls on their options, so they really do juice their own dividend. And it's a crazy dividend. And when we bought it, that is not a severe discount by any means. Like we're comparing 0.2, right? 0.5% of discount compared to 50% off at HFRO. But for this one fund, OXLC, they rarely hit discount territory. So whenever they hit discount territory, regardless of how steep or how small it is, regardless of how steep or minimal it is, it's worth putting money into it because they generally sell for premium. And no, I mean, overall premium price doesn't really matter until you sell it, right? I get that overall, but I mean, those little blips are a great time to pick up shares. And it's a really good time to pick up a fat dividend. So this is all I got for the week. Investment into bonds and loans, or here, I'll hover here. Bonds and loans, portfolio, it's bonds, energy infrastructure, real estate. It ticks all the boxes. Corporate bonds that are all US based. Pretty much real estate, everything. And then my two favorite guys talking about NBXG and how they, I'll widen this out and you can read the whole thing. But talking about how NBXG really boosts their dividend, but also how they structure the company. And looking at the track record of when the company started, it just seems like it's going to keep growing, and it's set up to where they're invested in 5G reliable companies, but it's not outright investments into Microsoft, Apple, Google, and the rest. It's invested into some of that, but it's not like you look at some technology portfolio, like ETW has this technology. It's a technology portfolio that's Microsoft, Apple, Google, this, that, the other. But when you really break it down, there's not a lot of technology in it overall. NBXG is all technology, but it's all companies that will profit by 5G. And that's the direction the country's moving. So anything AI that from their marker will help their company grow, that's what they're interested in. And that's what we're interested in. So that's what I got for the week. If you like the content, consider subscribing to my channel, hit the like button, head over to Facebook and join my group there called Navigate Your Finances. And as you face the week, as you face the rest of summer, you are the captain of that ship. So make sure you steer that ship where it needs to go. It is very easy to be lax at the helm as we all cruise through summer, right? But we're not playing the short game. We're playing the long game. Our job is to get from where we are to where we want to go. Just because it's the summer doesn't mean it's the best time to relax. Use always use your skills, use what you have, uh, but have that long game in mind because there are a lot of things that look like that shiny coin that look really tempting, right? Like it's an easy score. My advice is play the long game. Your job is to get from where you are to where you want to go, right? Don't just follow the diversions. Don't just follow the shiny coin because a lot of the time that's not all it's made out to be. So as captain, you're tasked with getting your boat from where you are to where you want to go and beyond. Game plan, make your strategy, and if you have no idea what I'm talking about, then come check my group out on Facebook. So regardless of where you're going and why, you are tasked with making it happen. So make it happen. This is Daniel Young signing off. I will see y'all on another video. Hope you have a great week. See you on another one. Bye-bye.